What if one wrong investment decision could cost a company millions? Capital budgeting is the process companies use to decide whether a long-term investment is financially worthwhile. For example, if a project has a positive net present value and manage accepted. Net present value measures how much value a project adds today by discounting future cash flows. This accounts for the time value of money you find present value. If the NPV is positive, the project is profitable and should be accepted. Internal rate of return is the discount rate at which the project's NPV becomes zero. We compare IRR to the cost of capital. The decision rule is to accept a project if its IRR is greater. The payback period shows how quickly a company recovers its initial investment. It focuses on time without considering the time value of money. In this example, the payback period is 3 years. In practice, companies evaluate all three methods, but prioritize NPV when making final decisions. NPV measures value, IRR measures return, and payback measures speed. NPV tells you how much value you create, IRR shows your return, and payback shows how fast you recover. But in the end, value creation always comes first. Struggling with investment choices? Let's break down the tools. First, NTV, the value of future cash flows today. A positive NTV means points the break-even money rate. Payback show 3 for the best decisions. Thanks for watching. Net present value shows how much value a project adds today by converting future cash flows into today's money. Future cash flows are discounted to their present value. If the NPV is greater than 0, the project creates value. Internal rate of return is the percentage return a project generates. We compare it to the cost of capital or required return. If the IRR is greater, the project is accepted. The discount rate represents the required return or risk level of an investment. Higher risk leads to a higher discount rate. This rate is used to convert future money into its present value. The cost of capital is the minimum return a company expects before investing. It is based on the cost of debt and equity. This threshold is used as a benchmark for investment decisions. Cash inflows are the money a project generates, while outflows are the costs required to run it. $1 today is worth more than $1 in the future because it can be invested to earn returns. We adjust future cash to today's value so we can compare it properly. For example, a lemonade stand expects $1,000 next year. We discount it by 10% to find its value today. Imagine a company planning to open a new store. It will spend money up front, but expects to earn profits over the next 5 years. A company may invest in launching a new product, expecting future sales to recover the cost.
These decisions are not made by finance alone. They involve management, strategy teams, and approvals.
Companies have limited resources, so they must choose the projects that deliver the highest value. Projects must fit within the company's budget and strategic priorities. In real companies, capital budgeting is not just a formula. It's a structured decision-making process involving finance teams, management, and strategic planning.
NPV measures value, IRR shows return, and payback focuses on time.
NPV is the most reliable method when the goal is maximizing shareholder value. However, it has a key limitation. As the rate increases, the NPV to the decreases, which can be misleading. IRR works well when comparing returns, but can be misleading in complex projects. Problems: multiple IRRs possible, doesn't show actual value. Payback is useful for understanding risk and liquidity, but ignores long-term profitability. Problem: it ignores the time value of money. Payback is useful for understanding risk and liquidity, but ignores long-term profitability. A key limitation is that it ignores the time value of money. In the end, capital budgeting is not just about calculations, it's about making strategic decisions under uncertainty. NPV measures value, IRR measures efficiency, and payback measures risk.
NPV shows value, IRR shows return, payback shows speed. But in the end, smart companies choose value.
Thank you for watching. Like, share, and subscribe to stay ahead in finance.